What is the stock market? The stock market is basically a global electronic network where you can buy company ownership, aka stock shares, in public companies listed in the stock market exchange. Owning a company's stock share is owning a share of a company. Therefore, the company's stock share is related to the company behind it, meaning that it can go up or down depending on many factors. For example, if Apple is able to increase its profit and has a successful new product, Apple company will become more valuable, which in turn raising its stock price. However, on the opposite side, if Apple new product fail and there is a bad news for the company, it will make the company less attractive to investors and bankers, which will lower the stock price. So what is the difference between a public and a private company? Can you buy stock from a private company? The basic way to look at it is that the difference between a public and a private company is that a public company is a company that's listed in the stock market exchange like New York Stock Exchange or the Nasdaq. A private company is a company that is not on any type of stock market, and you cannot buy company shares and buy ownership in that company. Why do companies go public? Most companies that go public do so to raise money by selling shares or part of the company to the general public in order to pay up debt or expand their business. In order to go public, the company usually has an IPO, which stands for Initial Public Offering, and usually the first day of IPO, there will be many investors like bankers and hedge funds putting in their money buying shares of the company. With the new age of technology, if you want to invest in a public company like investment bankers and hedge funds, you must have an online brokerage account. For example, in the US, in order to buy shares of Facebook, you need to open an account with any brokerage company like Fidelity, TD Ameritrade, Scottrade, E-Trade, Robinhood, and many more. The account usually is linked with your bank account, so you can transfer your money into the brokerage account to buy company shares. Are you an investor or a trader? This is an important question to ask yourself before you put your money into the stock market. An investor is usually think long-term, where they buy stock shares and hold it for months and years for the stock share value to go up significantly before they sell it. A trader thinks short-term, they either long or short a stock, depending on the stock market condition. For experienced traders, they can buy and sell shares in minutes, hours, and days by reacting quickly to the stock trend movement. So how does buying share work? How do you make money buying shares? First, if you're hoping that the stock that you are buying will go up, that means you are bullish. You want to buy in at a certain price and hopefully it will sell at a later time with a higher price. You usually want to be bullish when the stock market is good and everything is going up. During this time, stock traders and investors usually label it as a bull market. On the other hand, if you are hoping that the stock will go down, then you are bearish. In this case, instead of buying a stock, you are shorting a stock. It is a little bit difficult to understand if you are new to trading. To simplify it, shorting a stock means borrowing shares at a certain price and hopefully buy it back on the return at a lower price for profit when the stock market is bad or crashing. It is a bear market, and usually stock traders like to short the stock. A lot of people say that the bull market is good and bear market is bad. You want to buy low and sell high. This is usually true for beginner traders and investors. However, it is not the case if you understand and have experience playing both sides of long and shorting a stock. With experiences, you can make money longing when it's a bull market and shorting when it's a bear market. For example, in the case of longer stock, you buy one share of ABC company at $10, hoping it will go higher. At a later time, whether it's a minute, 30 minutes, hours, days, weeks, or even years later, the share went up to $11 per share, and you decide to sell it. You then make $1 profit or 10% profit on your original $10 investment. But what if something bad happened to the company and the share went down to $9 per share? On your brokerage account, it will show your profit and loss, aka P&L, as -$1 or -10%. It's important to understand that you are technically do not lose $1 or 10% because you did not sell the share that you own. You can either cut your losses and lose $1 or wait for some time later and hope that the stock share will go up to sell for profit. Remember, you have to actually sell the share to realize your profit or loss. So during the time that you're holding the share, you are just technically up and down on a stock due to market trading, but you are not actually make or lose money until you actually sell the share. For example, If your share depreciate in values from $10 to $9 or even to $5, let's just say it go down to $5 and you don't sell it then and wait for the bounce back to $10, then you will never lose the money. However, this is important to understand. Stock share can go up and down. But remember this, stock share can always either go lower or higher than what you hope for. In this situation, what if ABC stock price dropped down to $3 or lower instead of bouncing back up to $10? What will you do? Will you regret not stop the loss at $9 or cutting your loss even at $5? Or will you continue to hold and pray that it will eventually go back up? What if the stock drop again and this time down to $1 and stay like that for a year? What will you do? Disclaimer: this is just a basic simplified version of how the stock market works. It is just companies that want to make money, so they offer company share of themselves to the public to raise money. You can buy those shares as investors or traders. Depending on how long you hold those stock shares, you can either long a stock, selling higher for profit, or short a stock, buy it back lower for profit. Knowledge and experiences are the keys in making profit in the stock market. Remember, with risk come reward, so please understand the risk before you invest and trade with your hard-earned money. A good rule that I always suggest to people who are interested in stock market is that don't put money in stock market if you cannot afford to lose it. Hi, I hope you guys learned something new from the video. Please let me know what your thoughts about the stock market. Let me know by commenting down below. Thanks for watching. For more video, click here to subscribe, and I will see you again on the next video.